a question on Yes Bank resolution plan. What do you think would be the right mix of investors when India is trying to revive the private lender? And also secondly, some of the private investors have also raised reservations that they didn't get enough time to calculate their investments or do due diligence. So do you think, although this needed urgent attention of the government, we have in a way rushed through the revival plan of Yes Bank, although we had a little bit more time till April 3rd, till the moratorium was imposed?
I think this is a strange question because on the one hand, if for instance in situations like this we don't move very quickly, then the question that is asked is, why has the government and the regulator not moved in quickly enough? And for once you're asking me, why is it that we're moving in quickly? So I find that question quite strange in that context.
No, especially when we talk about private investors complaining that they couldn't do due diligence when they had to calculate or make decisions for their investments. Although I said this needed immediate attention or action from the government, we've moved too quickly when it comes to reviving Yes Bank. And also your views on the right mix of investors.
Look, let's be very clear on the objectives of us in a situation like this. The objective is to ensure that we firewall, we take care of the depositors, we take care of the stability in the financial sector. Those remain the overriding objectives. So some of the objectives that you are pointing out, I don't know whether they actually should get factored in for a policymaker when it's private investment actually, which that's something that private investors have to actually take the risk return trade-offs. So I think what was really important here was to ensure that we firewall, take care of the depositors, and that's why the moratorium was imposed. And we move quickly to a resolution plan, which is exactly what has been done. Also, I had actually mentioned earlier as well in one of in my interactions earlier that once the anchor investment comes in, there will be other investment that will go in as well. Also, to your observation about private investors, I think let's recognize that. For instance, a lot of private investors talk about the global financial crisis. At that time, the regulator had moved in very quickly. I don't think anybody complained that the investors did not get enough time. So I find this a very, very strange kind of comment that is being put, and especially given the objectives that policymakers should have and actually have had in this, which I've made it very clear, which is protecting the depositors' money, ensuring that banking sector basically stability is ensured.
Okay. And so several bondholders have also moved court challenging the write-down proposed in the draft resolution plan, saying that their investments in AT-1 bonds have been written down. And as we are aware, AT-1 bonds are superior to equity. So do you think this will
They're not superior to equity. They are quasi-equity.
Quasi-equity.
So they're not superior to equity. I think let's make that very clear.
Okay. So will this not impact the capital raising plans of several other banks who would want to raise money from the market through this route? And some of the banks have already deferred their capital raising plans through AT-1 bonds. So what sort of an impact would this have on the entire banking system if we were to write down in AT-1 bonds in the final resolution plan that has been approved by the cabinet as well?
See, because this matter is sub judice, I will actually comment on it conceptually. I think conceptually what all investors must recognize is you cannot have your cake and eat it too. If basically the return on a particular financial instrument is greater, that is only because there is some greater risk. And if there is greater risk, in some situations that risk will indeed manifest. I don't think there is ever a free lunch. So let's be very, very clear on that. These AT-1 bonds, actually the contractual aspects on those bonds are very clear. Not just in India, world over, whenever not just a bank, a firm that goes into distress equity, the essence of the equity contract is that you basically make a lot on the upside, but when the firm goes into distress, you are basically the last in the pecking order, and therefore you actually will lose out. So again, I think I find these questions very strange. What we have to recognize actually is, if on the one hand we talk about respecting contracts, then we actually have to recognize that these are features of contracts, that if for instance you expect a higher yield, then that higher yield cannot come without actually higher risk, in which case that if that higher risk indeed manifests, then you have to basically lose out. So I think this let's be very clear. I think these some conceptual aspects we need to be very, very clear and iron it out, saying on the one hand, while investing, investors will expect a higher yield, and then ex post basically they'll also not expect to be written down. I don't think that kind of having your cake and eating it too works in financial markets.